a fair amount to get through. I probably should caution that some of this presentation makes for fairly depressing reading, but hopefully towards the tail end we'll get some positive tailwinds coming through. So without further ado, if we look at where South African mining currently is, and once again, contrary to the popular belief and I think the press that you get on a pretty much a daily basis, South Africa still commands a fairly substantial position globally in a couple of very key commodities, and you can see it on the table on the top left-hand side. You know, top 10 positions, certainly across the PGMs, gold, coal, iron ore. I think also, given where we are in the current commodity cycle, the extent of the exports out of South Africa in these key commodity areas is significant. You'll see a number of, cumulatively well above 200 billion rand in that table is currently being exported in those metals alone, and critically, as a function of GDP in the South African space, mining still makes up about 25%. So certainly isn't mature and isn't something that's to be sniffed at. From an employment point of view, also numbers are fairly chunky still. You know, we have come off of a very high base. You'll see in the late 1980s, almost 800,000 people employed in the mining sector. Of that, 500,000 people in gold alone. Today, we're at about 500,000 people. Gold, unfortunately, has taken the big decline there, down to 120,000 people. But net, when you do look at it, you'll find that the platinum industry has actually stepped up quite significantly and now currently employs almost 200,000 individuals. So we have seen some growth in key sectors, and you can really see the industries that are maturing to a greater extent. From an electricity point of view, though, and as has been said in a few of the presentations already today, the extent of electricity consumption in this space is still significant. And you'll see, particularly in the PGMs and in the gold sector, some fairly chunky numbers coming through there, and really the key drivers of electricity demand across the mining space generally. It is two sectors that I'm going to focus on extensively in this presentation, just so you're aware, because I think it's very topical given ongoing gold negotiations, platinum strikes last year, and obviously we'll feed into that fairly extensively. Probably the first and most depressing slides to look at. I see the slides have shifted a little bit on the presentation, unfortunately, but when you look at the relationship between rand commodity prices and the emphasis being on rand here versus where the sector has come from and is going to, you can see a huge differential coming through. There's a huge disconnect between what prices have done and what investor sentiment is ultimately telling you. Across both the gold and the PGM space, we're pretty much down to 30% of the value that we were. I mean, particularly in the PGMs, you can see very clearly on the bottom left-hand side that, at a peak, we were at 700 billion rand of market capitalization. Today, we're well below 200 billion rand, and in fact, Anglo Platinum yesterday hit a 10-year low on its share price. This is despite the rand PGM basket price doing what it's done on the bottom right-hand side, which has actually tracked higher, once again, contrary to popular belief. So the commodity underpin to the sector is still there, and I suppose the million-dollar question is, why are we sitting in this environment? And it goes back to investor sentiment. I can tell you that, being on this side of the fence, I probably haven't seen investor sentiment as negative as I've seen it, particularly internationally. And that extends through to ownership concerns, regulatory concerns. Power is obviously a big issue, and I suppose labor is obviously one that keeps on dominating headlines. But certainly something to bear in mind. And I suppose the hope here is that, is it darkest until the dawn? Hopefully we're at the bottom of the market share and we are going to see some capitulation. But it does make for fairly depressing reading, certainly on my side of the fence, when you see graphs and charts like you are seeing there. Looking at where companies are, and I suppose the exposure that companies have had, and certainly the audience here has got a far better understanding of this than perhaps what I do have. But critically, a lot has been said about labor inflation in South Africa, and when you actually look at the numbers, electricity inflation has far outpaced it. You can see on the chart, the bar chart on the right-hand side, that electricity inflation at the moment, the compound growth rate in that unit cost is at about 20% since 2008. Labor is, and I say only very loosely, only running at 10%. So overall mining inflation over the last 8-9 years has in fact been greater than 10%, which has diluted most of the gains that we've seen out of the rand performance in the commodity price that you've seen. I think it's also worthwhile to note here that the companies have obviously not taken this sitting still, and fundamentally there's been huge gains being made in terms of the efficiencies. Unfortunately, when you see the type of graph that you see on the bottom right-hand side there, which is the Sibanya numbers that have been made public, you can really see the discrepancy between reducing your power consumption from 550 megawatts back in 2003 down to about 400 megawatts currently, you can see what the absolute number in terms of the expenditure on power has gone up to. R500 million back in 2003, closing in on half a billion rand in 2003, closing in on 2.5 billion rand as we sit here today. So, you can really see the type of inflationary pressures that we've come from. Critically, and I think a point to note here, is that despite the outages that Eskom has obviously given to the biggest users, there's been 34 of them up until April. It's obviously accelerated in the last 2 months, but you're unlikely to see absolute revenue losses at a mining company level now at this point in time. That's not to say these issues aren't taking hold, because we are finding, and I think you'll see it very clearly when the company's next report, is that from a productivity and an efficiency point of view, there are certainly losses that are being experienced. The other thing just to keep in the back of your minds is that what mining companies are doing generally to address the type of throttling that they're getting from a power supply point of view is that they are adjusting their processing to suit. As a result, wear and tear on the processing plants, particularly on furnaces in the PGM space, is going to be significant, and you are going to find accelerated rebuilding of those type of components. So, it really is going to come through, I think, probably more clearly from a capital cost point of view, rather than an absolute revenue loss at this point in time. Given the type of outages the companies are experiencing, given the unit cost inflation that the companies are experiencing as a consequence, it probably is no surprise that these other energy alternatives are being considered, and a lot of them are going to be discussed over the next couple of days. But certainly solar, biomass, even something as outlandish as fuel cells, these things are coming to the fore again, and companies are doing a lot of work, probably more out of necessity rather than a want to have. Once again, quite depressing readings. When you look at what's actually happened here, I mean, we saw an earlier chart which thankfully correlated quite nicely to the chart on the top left-hand side. But in real terms, electricity prices actually declined during the 70s and into the early 80s, which I think is something that a lot of people aren't aware of. You can really see the real cost inflation from a power point of view came through very strongly in 2008. The net effect of that has obviously been you've driven South Africa from being a very low-cost electricity supplier to being somewhere towards still the back end of the curve, and you can see it quite clearly in the top right-hand chart there. Unfortunately, had NERSA granted the type of tariff increases that Eskom was after, you can really see on that chart how quickly it would accelerate South Africa up that cost curve, pretty much to being the third most expensive power supplier in the world. So just please bear that in mind. This has a fundamental impact on the consumer price inflation outlook for South Africa, and as a house, Credit Suisse is really looking for a pretty substantial spike in CPI. You can see it on the bottom left there. And that obviously has a significant bearing on the outlook for the consumer and also for corporates. The only way the Reserve Bank is going to be able to get that under control, surprise, surprise, is by raising interest rates. We are expecting 100 basis points of interest rate hikes over the next 4 meetings. That's starting pretty much from September onwards. And that's going to have a fairly significant bearing on already stretched balance sheets, on an already stretched consumer, and I think fundamentally also look for other utilities to obviously inflate at a pretty horrible rate. I mean, the indication is that water inflation could probably hit as high as 17% should the type of rate increases that have been applied for being granted. And I will give you a brief sense on where we think that's going. In absolute terms, you can see the effect that this unit cost inflation has had on the industry as a whole. You can see, once again, the discrepancy between power and utilities and labor is very clear. In real terms, power and utilities have gone up by almost 250% in the gold industry from 2005. Labor, once again, very loosely, is only up 100%. In the PGM space, power is up 100% in real terms, and that's caused this dramatic shift up, obviously, in unit cost production. You have had some reaction from the rand commodity prices, as you've seen, but certainly at the moment it really does look unsustainable at its very least. From a cost component point of view, and once again no real surprises here, your share of costs associated with power also on the dramatic increase. Gold power was 11% back in 2005, it's currently 17%. In the PGM space it's increased from 9% in 2005 up to 11%. So it doesn't sound like a lot, but certainly the absolute inflation that's associated with that is significant, and it's taking a lot of that sustainability out of the industry. Had NERSA granted the increases, and I suppose the question is going to come up, when are those increases going to come through? Because as we've seen, the ability of Eskom to fund the shortfall that it's got is very clear. you would have seen gold, 20% of gold's unit cost would have been power, and PGMs would have accelerated to 17% by 2018. So once again, fairly depressing reading, and I think gives you a very clear sense of the need for a mining company to have an alternative solution, which is, I suppose, the good news to the audience sitting here. The companies, when you look at it, and this is a focus on the PGM industry, and you've heard it earlier, have been unable to recoup the type of inflation that you've seen from improved employee productivity. So when you look at it in absolute terms, you can see the PGM chart on the top left-hand side. 20 billion rand is what the industry was spending back in 2006 on its various cost bases. By 2018, we have that up to 70 billion rand, so pretty aggressive numbers. Unit costs have inflated from 2,000 rand a PGM ounce up to 6,000, 7,000 rand per PGM ounce. And you can really see the momentum behind these type of metrics. Unfortunately, at the same time, employee productivity has structurally declined. Now, you don't really pick it up because we are expecting some gains in employee productivity going forward. But from 2004 through to 2014, employee productivity in the PGM space declined by 20%. When you put all these things together, you get some fairly aggressive charts, and you can see it on the bottom right-hand side there, where unfortunately your unit cost versus efficiency has in fact increased threefold. Once again, reiterates the point that companies are trying to, or certainly going to have to do more with regards to their power and possibly also the labor outlook. Having met with Anglo Gold recently and Anglo Platinum recently, Anglo Gold has cut its power consumption by 30% over the last 6 years. Huge gains being made, similar to what we saw with Sibanye. Amplats have reduced their power consumption from 950 megawatts down to 650 megawatts, yet you're still getting the type of inflation and the type of pressure that you're seeing on the charts in front of you. What this has meant for the JSE as a whole is that when we've looked at the total mining capitalization of the JSE and when we've looked at the stocks that are exposed here, you've had a 350% increase in the net debt that these companies have got. It's obviously a function of the unit cost inflation, but also obviously of the commodity cycle that these companies are exposed to. A lot of that debt, which is now sitting at about 1.2 trillion rand, is in fact sitting within the diversified miners, so your real big players. But even when you strip those out, unfortunately, you've had a huge increase in the companies that are sitting with a net debt position, about 84% since 2008. So once again, shows you how much pressure the industry is fundamentally under here. In terms of the companies that have got net debt, that's increased from 30% back in 2008 to 60 odd percent currently. So yet again, the sustainability of these type of numbers, given the type of environment we're in, is obviously fairly worrying. When we've then drilled a little bit further into the gold and the platinum sector, as we sit here today, we believe that the gold free cash margin, this is after capital, largely stay in business capital, is about 13%. About 30% of the industry, we believe, is currently underwater, currently loss-making. Had NERSA granted the type of increases that Eskom is after over the long term, unfortunately, gold's cash margin drops to negative 9%, and based on the current numbers, we believe that 80% of the industry would in fact be loss-making. Once again, we need to do something to address the type of increases that we're seeing. It's not much better in the PGM space, unfortunately. Fundamentally, as a house, it's a space that I've looked at for a long period of time. We believe that the PGM industry needs EBITDA margins of at least 30% to justify stay-in-business capital. Sounds like a massive amount, but I mean, we all know the type of underpin from a stay-in-business capital perspective that we need in the sector. At the moment, it looks like 45% of the industry is underwater. Had that increase gone through, that would have increased to about 60%. So very, very depressing. The challenge with renewables, and it's already been mentioned, thankfully, in a couple of previous presentations, is that renewables are going to have to compete with a diminishing capital pool. Shareholders want dividend returns. There has been some discontent with around the type of projects that companies have been investing in. You've all seen the type of impairments that companies have had. Globally, you can see it very clearly in the diversified miners. Their capital pool globally is reduced from $70 billion in 2013 to $40 billion currently, and you've seen similar adjustments coming through across the other commodity sectors. So you are going to have to compete. I suppose the argument would be, at this point in time and this point of the cycle, we would probably argue that an alternative energy solution is really a question of sustainability rather than a nice to have. So as a consequence, I think the guys that are in this space will really be able to leverage off the improved efficiencies that we've seen across the renewable energy space. You can see it in that chart in the bottom table. And as a result, I think you're going to find that certainly projects are going to get renewed focus from mining companies. Interesting chart on the top right-hand side is just trying to put the read-through of these of this cost inflation into where we've seen prices going. Back in 2008, the first two circles there, when we had the first Eskom power crisis, we had a dramatic increase in the platinum price as a consequence. Investors rushed into alternative investments, drove the platinum price back up to about $2,000 an ounce. When you look at the type of industry that we're in currently, you can see it's had the exact opposite effect. So despite the current strategy that you've had, or the current issues that these companies have had to deal with, unfortunately the commodity prices haven't followed suit. So the ability of a company to pass through these issues is unfortunately at this point of the commodity cycle not there, which obviously doesn't bode well. Good news, and this is from the EIA thankfully, is that the host of alternatives is very, very small. But the host of alternative, in terms of alternative energy solutions, is certainly getting broader and broader, and critically at an improved efficiency and a reduced cost, both operationally and from a capital cost point of view. The EIA estimates that capital costs over the last 3 years have reduced by 2%. Doesn't sound like much in dollar terms, but certainly I think that momentum is going to be carried through, and once again, makes these things far more palatable to a mining company that's dealing with the type of headwinds that they are. As has already been mentioned, I mean, we certainly still expect some baseload capacity. A mining company isn't going to be able to move completely away from having some type of capacity and some type of reliance on Eskom. Having said that, you can really see that in terms of the peak and troughs in those various, in that Eskom profile, as I've already mentioned, the mining companies are trying to address that by their processing. They are switching their processing around to try and not be absorbing energy during those periods, and as a result, they are trying to actually manage the base load capacity issues that they currently are having to deal with. So now, hopefully giving you some positive points here. It's not all doom and gloom, I promise. First one, which is doom and gloom, is that load shedding is here to stay, right? We are getting very conflicted reports out of the various government departments that we deal with. This is straight from Eskom. This is a best case type scenario, but it does look like we will have some type of load shedding through until at least 2018 on a best build out capacity. Once again, reiterating that mining companies have to have a strategy around this solution, around this issue. The other point, which has been slightly addressed this morning, in fact, on the way here, is that Eskom has a huge funding shortfall, which we're all aware, which I think goes back to the point that from a tariff point of view, we're certainly expecting the type of momentum behind the tariff increases that we've seen, the type of demands being made. That, unfortunately, in our opinion, is not going away. So at the moment, as we sit here, government has committed to transfer a 60 billion rand loan that they made to Eskom into equity. You've seen that government have sold its Vodacom stake as of this morning for 20 billion rand. That's all going to be used to pump Eskom up a little bit. Unfortunately, on the latest numbers, there's probably still a 220 billion rand shortfall in Eskom's accounts that are going to have to come from somewhere. And unfortunately, it's us sitting in this room. Eskom is making provision, despite this increased risk of load shedding, for renewables. And as was mentioned earlier, it's shown on a net demand basis. And you can really see it's having a huge impact on the type of base load capacity that Eskom wants. I think critically, when you look at the top right-hand chart, though, consumers haven't cut their power consumption as aggressively as I suppose what Eskom would have wanted, and certainly the generation has not been there. It's a quarter-on-quarter chart. It's over 13 quarters, and you can really see that of the 13 quarters in play there, your production on a quarter-on-quarter basis only increased 5 times. So the trend is still somewhat subdued, somewhat volatile, and I suppose it just once again ramps up the risk of load shedding and really makes the sustainability of the mining industry and the need to have an alternative energy solution in place even more critical. And it really becomes critical when we look at the positive side of things. In order for mining companies to capitalize on what we believe to be great macro conditions, and I'll touch on them in a slide's time, but our view on the commodity outlook is exceptionally positive still. Despite 2015, and you can see the chart on the bottom right-hand side, it's been a bad year. The only metal that is up in US dollar terms year to date is oil, up about 10%. Everything else has had a pretty dire year. It's around concerns around China, as you're well aware. There's concerns around the EU, given what's happening in Greece at the moment. But when we've looked at the fundamentals, and we've looked into 2016, 2017, and 2018, when our long-term sustainable prices kicked in, you'll see some pretty chunky numbers coming through there. We're looking at anything from plus 20% to plus 30% in US dollar terms from where we are today. So the outlook is still exceptionally positive from a commodity point of view. And in order for companies sitting in South Africa to capitalize on this, you obviously have to have provisions in place for it. So certainly the outlook from a commodity perspective is not as weak as I think what current commodity prices would tell you, and certainly what market commentators would have you believe. A very busy chart, unfortunately, but as I've mentioned, we are positive on global macro. There was a weak Q1 in terms of global growth. We're not expecting it in the top middle chart. We're not expecting that to reoccur, and in fact, we're expecting global growth to tick up higher through the remainder of this year into 2016. The other critical point here is that unemployment, even in some way as, I suppose, as messed up as the EU currently appears to be as a periphery, unemployment has in fact peaked in a lot of countries and is turning itself down. That's obviously critical from a consumption point of view, and you can see it on the top left-hand chart. The US, the UK, the EU are all getting towards pretty decent unemployment numbers on the low side, obviously. So once again, consumption trends are looking forward. The other critical thing with regards to global growth, bottom left-hand chart, is that it looks like it's going to be broad-based and pretty harmonious, which is something we haven't seen before. We are expecting pretty much every region globally to maintain the type of growth rates that we've seen historically. And once again, this includes somewhere as dysfunctional as the EU currently appears. So expect global growth to carry on growing, and ultimately that feeds very nicely, obviously, into our commodity outlook. Big question mark is obviously China. Given the type of slowdowns you've seen in China, there's a lot of concern that can China maintain a 7% growth rate? What does that mean from a commodity consumption point of view? When we've looked at how proactive the People Bank of China have been in terms of stimulating the economy, it's been fairly dramatic. They've cut interest rates by 90 basis points since November 2014 in light of slowing growth numbers. So the Chinese economy is being propped up by very proactive monetary stimulus and monetary policies. Sorry, just going back to the EU, one other point I have to make here is that from a quantitative easing point of view, in terms of propping up the EU, we're also not expecting that to slow down. Until inflation rears in the EU, and until you see a sustained inflation rate in the European Union, we do believe that quantitative easing is here to stay. So the Chinese economy is looking pretty solid, to be honest. There have been concerns, but once again, I think certainly bake in that the Chinese government and the People Bank of China are going to step up here and really implement the stimulus measures that they need to. Going back to where we started the presentation, in terms of looking at the two sectors that are huge electricity consumers, platinum and gold from a commodity point of view. From a gold point of view, there's been a huge overhang of the risk of a rising US federal rate. And you can see it on the top left-hand chart there. We believe that the trade is oversold. So even with the US Fed likely to raise rates in September, we do believe that that gap is in fact too wide. And as a house, we're expecting the gold price to probably stabilize at somewhere near $1,250 an ounce in real terms going forward. It's not a great deal better than where we are today, but fundamentally, as I say, it does give some support to the commodity. We are very bullish, and some people in this room will know how bullish we are with regards to the Pgm Outlook. When you look at those charts, the middle chart and the right-hand chart show the type of market forecasts that we have for platinum and palladium. Those bars ticking down show a distinct differential between supply and demand. You want to see those bars being negative. It's showing you that demand is exceeding supply, and in fact at an increasing rate in real terms. So net, that bodes very well from a fundamental support point of view, and you can really see it in the price deck forecast going forward. As we sit here today, the PGM industry, and I suppose to a lesser extent the gold industry, is completely and utterly unsustainable on a stay-in-business basis, let alone a growth basis. And that really dictates why we think the PGM price, particularly platinum and palladium, are going to tick up quite nicely over the medium to long term. I suppose in conclusion, and I think I've run a little bit over time, but in conclusion, hopefully I've given you a sense that as doom and gloom as it may appear to be, the time to capitalize from a company's perspective is now. Unless companies are going to miss the next commodity upturn, which we don't believe is that far away, probably within the next 24 odd months, we're going to see a sustained recovery in these commodity prices globally. And unfortunately, unless South Africa is going to miss it yet again, like we saw in 2008, we do believe that companies need to actively address this, and I think they are actively addressing it. So I hope you have a great conference, and I hope the next 2 days are hugely insightful. Thank you.